Hi guys, the last video was all about how overvalued the stock market is compared to the historical PE ratios going all the way back to 1880. If you didn't check out that video, definitely do so. It's really a cool one. I think it puts things into perspective. And I think the argument there would be, well, they've printed so much money that it might be justified, or interest rates are so low. Yeah, okay, fine. But that just implies that interest rates are going to be low for eternity. And I don't think that's necessarily true. They might be low for a long time, but it still doesn't mean they're cheap. And if you guys are rebel capitalists, you like to buy things when they're cheap and sell them when they're expensive. And right now, there is nothing cheap about the broad stock market. Let's say the S&P 500. And then if you say, well, the money supply has increased, which I'm going to bring up right here, you would be definitely correct. But if that hasn't gone down to the corporations themselves, then if they're not making any more money in nominal terms, then their valuations are still extremely high. And I think we see a great example of that when we look at the stock market going to almost all-time highs, but the economy itself, which the stock market should be a reflection of to a certain degree, the economy is, if you take out all the stimmies, the economy is as bad as it has been since the 1930s. When you look at the reduction of GDP, so you've got a 1930s type of structural economy, but a late 1990s type of stock market valuation. That dog don't hunt. So I concluded the last video saying, okay, what can we do? Well, things that we talked about in Rebel Capitalist Pro all the time with my partners Lynn Alden and Chris McIntosh. I always put links in the descriptions below. $1 trial if you guys want to check it out. But one thing we've been talking about, just simply gold. And I know that gold isn't at an all-time low, or historically speaking, even adjusted for inflation, it's still high. And it's close to where it was back in, let's say, 2011. But the money supply has increased dramatically. And I would use that as a direct comparison with gold, because gold is money. And it doesn't have a P&L, or it doesn't have anything like that. It is money. So I think that's a much better comparison than taking the money supply and looking at the S&P 500 compared to that, or maybe even housing, because then what you're doing is you got to look at incomes as well. So again, don't want to get down or go down that rabbit hole. Let's stay focused here, George. Stay focused. So I just pulled up a chart of the GDXJ, and I'm not saying this is a good way to play the juniors, but it's kind of a broad 30,000 foot level view. And we go back to when gold was at its past high, call it 1900, and the GDXJ up at 171. Now, I didn't even know what a yield curve was back in 2010 or 2011. I didn't start studying anything until 2012, and I really, you're learning just bit by bit. So I don't know if somehow the GDXJ was different back then. I don't know if it was measured a different way. I'm not sure. You guys can let me know in the comments below. But assuming it's apples to apples, which I believe it is, because I pulled up the GDX just to kind of double check. You're looking at something that, although the price of gold isn't historically low, my goodness gracious, the juniors are, I would consider them cheap. And again, this isn't adjusted for inflation. We'd need to do that, but wow, they're looking pretty good. Also, when you consider the costs of a big portion of the costs for gold miners is diesel fuel. And so the price of oil, therefore distillates, being very low right now, that means it's even better for their P&L, their bottom line, So I'm not saying go out and buy gold miners or anything like that. And I want to be very clear that the way I set up my portfolio, it's a 10-80-10. Again, this is something we talk about a lot in Rebel Capitalist Pro. If you guys haven't heard about that, so 10% I allocate to insurance. That's kind of how I compartmentalize it in my mind. So the 10% would be physical gold. That's what insurance is to me, just to maintain my purchasing power. And 80% I would define it as an investment. So that is something that pays me to own it. That's just my definition. That would be real estate, a rental property. That would be a dividend paying stock, like an oil producer, as an example, a tobacco company, a coal company. All of these I'm sorry, I didn't buy tobacco, but the oil and the coal I bought back in March, paying fantastic dividends. So, and tobacco, by the way, is paying a great dividend now too. So anyway, that would be an example of an investment. Okay. The other 10% would be what I consider a speculation. So it's not really paying you to own it, but it's more that you see a lot of asymmetry. So a lot more upside than downside. And for me, the gold miners, maybe the juniors, that's what's kind of looking interesting right now as far as a speculation, because everybody's talking about Bitcoin. Everybody's talking about stocks and Tesla or cryptocurrency. People kind of forgot about the gold miners, in my opinion. So I'm not saying to buy them. I'm just saying that I'm kind of putting them on my watch list, just an FYI. And then we go over to the supply of money. So let's take this back to a 5-year chart. You can kind of see where we were down here, maybe 33 on average, got up to, call it, maybe 50, 51 back in 2016. And so from that point in 2016, I mean, we're pretty much the same level, but look at the money supply. Money supply has gone from just this year. The money supply has gone from basically 15 trillion up to over 19 trillion. So call it a 25% increase in the money supply. So that's a huge increase in the supply of what you're comparing gold to. Its competitor, let's say money. So I think this would be a huge tailwind for not only gold, but the miners, and therefore be even further argument as to why, excuse me, pulling back to that max chart, that yes, they were cheap around here, but my goodness gracious, when you see the money supply increase M2 by 25%, they could be maybe cheap right here. And again, I want to be very clear. I'm not saying go out and buy them. I'm not saying I'm buying them. I'm not buying them right now. I'm just telling you I'm putting them on a watch list for this reason. And then we kind of compare the juniors with the GDX. And we see it's pretty much the same story going back to 2011-ish, end of 2010, we hit a peak, and it was about, let's say, a little less than double the price it is now. But looking at that 5-year, about from here to here, there's a little bigger delta than there was, a little wider difference than there was with the juniors. But you see how when we compare this increase from 31 to 35 or 36 to the increase in what gold is competing with, the supply of dollars in the real economy, it's just, it's night and day difference. So wanted to bring that up just as a quick idea. See you on the next video.